Okay, so thanks for tuning the video blog today. We've got a very, very special guest with us today, Brian Wesbury, who is Chief Economist at First Advisor Trusts. He is written up in all kinds of publications. Brian shows up on Fox News, Fox TV, Fox Business, Bloomberg, CNBC, stations in Canada. He's everywhere. He was Chief Economist for the Joint Economic Committee of the U.S. Congress in 1995-96, named the #1 economic forecaster back in 2001 by the Wall Street Journal. Why you have not been named #1 for the past decade, I have no idea. But with that, ladies and gentlemen, I give you Brian Wesbury.
Hey, thank you, Jeff. It is great to be with you. You know, winning those forecasting contests, it's almost like downhill skiing in the Olympics. You know, after 3 runs, somebody is separated by somebody else by the 3rd decimal place after the 2nd, and you know, you win by 0.002 seconds, and that's sort of what goes on with those forecasts. So if you have a 6.2% unemployment rate and it's only 6.1, you know, somebody else, you know, missed it by less than that. So anyway, it was lucky winning that year, but that year was also a recession. You know, a lot of people accused me of being too optimistic, but back then I actually won that contest for predicting the recession in 2000, 2001.
Right. Well, you're, like I said, you're #1 here at Green Financial. And by
Thanks,
the way,
Jeff.
Happy birthday today.
Oh, it is.
Your whole birthday to come hang out with us. Thank you so much.
It lets me forget that I'm having a birthday, so I'm happy about that. Thank you, though.
Yeah, well, good. Well, let's get right into it. So I had sent out to some of my clients, you know, hey, send me some questions back. There's been a common theme of different concerns clients have had, and I kind of want to just kind of hit on some of those with you. And first being, there seems to be a little bit of a disconnect between the stock market and the economy. So
Right.
we see like Home Depot, for example, the stock do very, very well. The mom and pops out of business to some degree, not all of them, but they have been, you know, nobody told the mom and pop you had to, they told the mom and pops you had to close, but Home Depot got to stay open.
Right.
So we've seen some of that, but is the stock market accurately reflecting the fact that some of these mom and pops will never come back?
Yeah, Jeff, it's a great way to put it. I am worried, by the way, that many mom and pops restaurants won't come back. Now, some of them, I mean, it's not awful. In other words, if you ran a successful restaurant for 35 years, worked 13-hour days, 7 days a week, you were already looking for a way to kind of retire and, you know, stop, and your kids didn't want to take it over, and this was the perfect excuse. So that's a good or the best outcome, I guess, we could hope for. The other ones, if you're not allowed to open, if you can only have half of your restaurant filled, a lot of these companies are never going to come back. And so and that's why I believe it's going to take years before unemployment comes back down. But to go back to the stock market, you're absolutely right. Home Depot, Target, Walmart, Costco, they were all allowed to stay open, considered essential, and they won out of this. But we also had a whole group of companies like tech stocks that won. Here's the way I look at the tech stocks. We had 6 years of growth in 6 months. You know, look at what we're doing right now. I mean, you're sitting in your office. I'm actually sitting in my house, but we're able to connect, and that means these tech stocks have won. Theaters got crushed, but Netflix went through the roof. And I'm not saying, you know, go buy Netflix. I'm not saying that, but you know that they won in this process. Right. And in order for these companies to make it in the S&P 500, even if they're not tech and if they're not the big box stores, they were in pretty good shape. I mean, I'm not saying every single one of them had a perfect balance sheet. Lots of them didn't. But the fact with interest rates so low, the cost of capital came down, And on top of all of that, and this is something we have to remember when we look at the market versus the economy, at the bottom in April, and when we run our models sort of in reverse, if you will, we said, okay, the S&P 500, I think it hit 2280 or something like that, and it's now well over 3,000. But if you put that number into our model with a discount rate, then we say, what is the market saying profits are going to do? And at the bottom in April, the market was saying profits are going to fall 80%. And we thought that was way too much. And it turned out that in the end, in the second quarter, profits were down about 20% from a year ago. So the market overdid it to the downside. And that's one of the reasons why it's bounced so hard to the upside. And it seems to be doing better than the economy, but that's because it did worse than the economy originally.
Makes a lot of sense. And along those same lines, granted, we've seen a pullback in the market these past few trading sessions, but so prior to that, and even right now, would you say that the market is, overheated, fairly priced? Where would you say that the market is in terms of valuation?
Yeah. These last 3 trading days have been, a big drop, but we have to remember the NASDAQ's still up over 20% for the year. The S&P is still up over 4%. And the S&P it was up well over 50% from the bottom before we had this last couple of days. And if we want to call it a correction, I'm not a technician. People can call it whatever it wants. It had run so hard with really never looking back. And now it's just, this happens to markets. There's volatility. Having said that, if you go back to last Tuesday, Wednesday, when the market, before the market had corrected, I guess is the best word I can use, we thought the market was undervalued. And one of the key reasons for that is that interest rates are so low. And so the lower interest rates are, the more profits are worth. And even if we put, so right now the 10-year treasury is about 0.65%, 0.65. Even if we put a 2% 10-year treasury in our model, which I think is, these interest rates are artificially low. We put 2%, it still said the market was undervalued. That doesn't mean that it's going to go up every day until it hits fair value, and we can have these kinds of pullbacks. So the market was frothy in the sense that it had run really hard, but it had never gone to overvalued, at least in my opinion. Now, there are some people who think it did. I don't. So, and so there's a difference between running hard, being up 50% in 6 months, and being overvalued. So yeah, it ran hard, and it was frothy in that sense, because you can't do that forever. And then you get these kinds of pullbacks. And, people that were waiting to get in, they were scared to get in. This is the kind of time to start, taking nibbles and taking bites. And if it goes down again, get in a little bit more. It's time to bring some of that cash off the sidelines. And I think people will. I think this market will return and go back to new highs.
Right. So, when you look at earnings, it's almost as if the market doesn't even care about 2020 earnings.
Right.
Like they're meaningless, and it's kind of looking out to 2021 earnings. And that's kind of, and by the way, in our opinion too, the market was just due for a bit of, it made quite a bit of run. So,
right. And Jeff, just to put an exclamation point on what you just said, I think you are absolutely right. The market discounts the future. And if we thought we were going to have a really ugly 2021, the market never would have done what it did. But most analysts, and actually a lot of these analysts look at from company to company. So they're going bottom up, looking at earnings, and then you aggregate them all together. And when you do that, next year, 2021, right now is expected to have all-time record high corporate profits. So, and some of those numbers are way up there. And I won't, get into that prediction game, but all the people that look at these companies from the bottom up are saying earnings are going to hit a record level next year when we look at the S&P 500.
That's good news. So let me, without getting, too political, many of my clients are very concerned about the upcoming election. So could you give us your thoughts on the continued economic recovery, regardless of who is in office, come January next year? And,
right.
maybe the potential outcomes of whatever administration is in there.
Yeah. So let me just say something real quick in a lead in to this, and that is that the amount of spending that the United States, government has done in response to this bailout, the coronavirus. First of all, when you force businesses to close and then people to be unemployed, constitutionally, if you will, legally, that's a taking. So this whole takings clause, and it's about, taking your land to build something for the city. And you have to be justly compensated for that taking. And so I look at this spending as just compensation for the forced closure of businesses. And that doesn't make it all this whole thing right or anything, but that's sort of the moral, ethical, legal way I look at this. Nonetheless, we're going to have trillions in debt that our kids are going to have to repay. Now, a lot of people go and look at this and say, debt's now over 100% of GDP. We're going to collapse as an economy. And I have never believed that, okay? We can handle this debt. The carrying cost is what we have to look at. And the carrying cost is actually lower this year, believe it or not, with all of this debt than it was last year. And it's because interest rates are so low. Now, I still believe that we should issue 50 and 100-year bonds to pay this back. Like it's going to take us decades to pay it all back. And if we can finance it over the long term, that's going to help the economy in the future. And so let's hope that kind of thing happens. Now, the economy, we were at 3.5% unemployment back in February. I do attribute part of that to the tax cuts that President Trump was able to move through Congress, and deregulation. All right, I believe that's why we were able to get down to 3.5% unemployment. But the sheer size and scope of the government, the amount of spending, kept us from having 3 or 4% real growth. We were still running around 2.5%. Was a little bit better than when President Obama was in office, but not a lot. And I think that had more to do with the spending burden on the economy. And so we have that today. No matter who wins or who loses, we have this bigger government, and that's a ball and chain it's a wet blanket over the economy. Now, I'm also going to put in here real quickly that when President Obama was in the White House, I actually talked to Sean Hannity one time, and he every night was telling the world that we're going to be in depression. But the technology that we have invented is so powerful that net we're going to still grow. And so I called it a plow horse economy. And so now we have to assess, if Joe Biden wins the presidency. I mean, on the surface, he said he wants the Green New Deal. He wants Medicare for all. He wants to raise taxes. And people use the $4 trillion number, but that's stretched out over a decade. We have to remember that. I'm not downplaying it, but it's not a $4 trillion tax hike in 1 year. But all of those things would be, I believe, a burden on the economy. Now, could we eke out a little bit of growth? Probably, even with that. Now, if President Trump wins, we're not going to do any of those things. And I think we will grow faster. So I do believe that President Trump is better for the economy in the future. And not that anybody should really care, but in 2016, I said that that Donald Trump was going to win and beat Hillary Clinton. I'm saying the same thing today. I do believe he is going to win. And then, I know that oil prices, et cetera, are important to a lot of your clients. And, the Green New Deal will not be good for that. It is, I mean, literally they say they want to shut down fossil fuels. Now, I don't know how you do that. The U.S. economy, I mean, look at California. They're shutting off the lights. And I think a big part of that has to do with solar and wind and trying to move to a Green New Deal in California. And I think that's going to have an impact. And just like these protests and riots are going to have an impact, just like people, missing college football and not having their kids in school, all of these things I think are going to boil. They're underneath. And that's the pressure cooker. And I believe that they cause people to lean toward President Trump. Having said that, it's a lot of people say we're going to go, just like Sean Hannity used to say about President Obama, that, it's going to be a depression. I don't believe they can get a full Green New Deal or Medicare for all or a massive $4 trillion tax hike through even a Democrat Senate with the unemployment rate at 7 or 8%, which is what it's likely to be next year. So I just don't think the worst case policies would happen, even if the new president was Joe Biden. But I actually believe that President Trump will win a second term, and that stops that from happening.
Well, even if let's say Biden does win and the House or the Senate, we're bound to have some gridlock there anyway, and not
right.
a lot get pushed through.
Yeah, exactly. And sometimes, I mean, if we just look back in history, and I'm not trying to say this will be okay. I'm not voting that way, but I'm a libertarian. I just want smaller government. That's what I want. All right. And so some of the things that Democrats are talking about go completely against my view of what's good for the economy. I'm not trying to be political. I'm just telling you where I'm coming from, and you can't get away from politics right now. And so people can be mad at me for that or not. I'm not embarrassed to say it. That's what I believe. I'm a libertarian. But if we don't think unemployment is going to get down below 4%, and we started off the conversation talking about mom and pop and small business until 2023, and it will be really hard to pass a big tax hike if the unemployment rate is still 7%. I never seen it happen before. It would be against all of history. And I just Republicans in that scenario where they lose the Senate and Joe Biden is the president, sometimes are even more effective as the minority, in fighting. And so we'll, we obviously all this will play out. But what I always warn people is, hey, go back to when President Obama was in the White House. There were all kinds of conservatives. It's just like liberals right now. They hate Trump. And a lot of conservatives hated President Obama. And it's just sort of the way our politics is these days. But their worst fears never happened. And we didn't have a depression in the economy. And so when I look at where we are, I don't like those policy proposals, but I do not believe they will be put in and passed in their worst form or shape.